Hi, and welcome to Finextra at Sibos TV. And today we're going to be talking to a panel, and we're going to be discussing the impact of Basel III. So joining me today is Lee Former from JP Morgan. Next to him is Phil Cantor from SmartStream, and last but not least is Lisa Rossi from Deutsche Bank. So I'm going to give a little bit of a preview, a primer to this. You know, SWIFT recently released a study looking at cash and liquidity risk managers and at financial institutions. And one of the more interesting results from the survey said that 82% actually lacked an ability to manage liquidity positions at firm level. So, you know, it's not a secret that the Eurozone's been experiencing a lot of volatility right at the moment. And of course, we've got the shadow of Basel III causing a lot of anxiety in the industry. So, I mean, how sexy a topic is cash management and liquidity risk right now?
Certainly we're hearing it a lot from our clients. Our clients are looking to have better visibility into their liquidity positions. Real time is always a buzzword when it comes to liquidity management. But in addition to just seeing their cash, they want to be able to mobilize it and have it where they need it. So better control, better transparency, which helps to reduce risk because they know what they actually have.
I mean, so where do the challenges actually lie? So if 82% of financial firms actually lacked an ability to manage and report liquidity positions at firm level, you know, how or when would a corporate or a bank know if its partners stopped making payments?
I think the liquidity topic is still sexy. I mean, after 300 years of being in the back room of banks, the global financial crisis suddenly brought it to the fore. And recent events have only underlined that. If you look at what happened on August the 8th, we've still got banks worrying about other banks. I often talk about the difference between a smoke alarm and a fire extinguisher. Stress tests are really about making sure your fire extinguisher works, but you need a smoke alarm. You need to know when something's happening. The Bank of England did a very interesting report recently, taking real data from a single day. They said if one bank had been suspected of being under some pressure, if two other banks had merely delayed the payments to that bank by 30 minutes, the impact on liquidity would have been a 40% increase in the liquidity needed, around $1 billion.
I think it's important to draw a distinction between corporate cash management liquidity and bank cash management liquidity. I think realistically, if 82% of the financial institutions in the world could not report on their liquidity at a firm level, there'd be a lot more banks already out of business. So I think it's important when you look at these sort of surveys and statistics that you try to put some context around them. Certainly I doubt there's a financial institution in the world who doesn't have a view of its liquidity, or they wouldn't be able to operate. I think how you take that the next level down, and coming back to your point about real time, right? We have a real time view as an industry of our trading positions. You can live in your RTGS desks, you know, and know what your actuals are. How you take that down a level of granularity to understand your counterparty risk, or to give your large corporates an understanding of their counterparty risk, is where financial institutions vary radically. And you know, some institutions are able to deliver the same level of cash management to their own corporates, and others aren't. And I think that is where the differentiator is in the marketplace. And it's one of the things that is gaining momentum for cash management at the moment, because everybody wants to be able to understand their own exposure. Not just the largest bank in the world, but the guy who has a sandwich stand in some country, where he's trying to understand whether or not his suppliers are going to be able to get stuff to him or not. It really does span the width and breadth of the business world, I think.
Yeah, that kind of leads me to my next question. I mean, it seemed like just yesterday people were talking about the need for intraday liquidity risk reports, and now they're talking about real-time risk reports. I mean, is that something that banks are moving towards, and what are the challenges to getting real-time risk management, liquidity risk?
I think most of the large global corporate banks are providing, if not close to real-time, near real-time information. Technology has come so far in the last 5 years to give us much better information than we've ever had before. And I think you need to employ that information to then be able to make those decisions. There are also systems that we use internally for our own review that we have now extended out to our clients in order for them to monitor their payment flows, to understand their risks, to understand their counterparty risks. So that only augments, I think, some of the controls that are needed and are being implemented today.
It's interesting that you said that about the real time, because I think absolutely everybody is getting much more into real time, and for a lot of this it's not milliseconds we're talking about, but it is fast. And for the Deutsche,
It's not high frequency trading, high frequency liquidity.
Well,
risk.
exactly, that's right. But you need the cut-off times are important, and the interim cut-off times are important. And you're absolutely right. The banks like Deutsches and JP Morgan's are providing much better information to clients and to other banks on statuses and so on. But still, other banks we talk to are finding they can't get a very high coverage of intraday messages, for example. And I think that's something that Swift is something we're talking to about, because actually, sometimes the network management people think they're getting very high coverage of intraday messages, but when we go in and do a study, you find that they're not. So there's that whole aspect of, are we connecting the industry up properly? Now, if you add to that a comparison, for example, with manufacturing industry, where if you speak to the boss of a big international car company, they know exactly where every car they own is at any moment of any day and all the parts. We aren't yet at that stage in banking, but that's really where we're trying to go to. Part of the problem isn't lack of data, it's too much data. There are too many different versions of the same truth. And so we're evolving to a position where we're getting multiple pieces of evidence coming in about, let's say, a cash flow. It could be an assertion by a relationship manager, it could be something booked into a system, it could come from a forecast, it could come from a CLS message, or a securities message, or a 202 cover, or an intraday message, until it finally hits the end-of-day statement. There's just so many of these different versions of the truth, and the job we're trying to do collectively in the industry is make sense of all this.
Mm-hmm. So is that why Basel III is causing so much anxiety in the industry? Because they don't know how to attack it because of all this data?
Well, I think it's, again, I'm a big one for definitions, and I think that you can't do real-time liquidity reporting for the simple fact that reporting is post-mortem, right? The very nature of reporting is generating a message about something that has happened in the past for whatever reason. I think most banks, I would imagine, are probably fairly well positioned in terms of monitoring their positions in real time, which is a totally different topic. Again, it comes back to how you manage your cash flow and how you manage your liquidity on the intraday market. I think the challenge is that literally within every different jurisdiction that any financial institution operates in, there are different regulations around how you have to take those snapshots at that point in time. And that's where the real-time element comes into play. It's not so much about real-time reporting, it's about what happens when a regulator turns up at your door and says, I would like to know what your position was against your counterparties at 11:27 p.m. on Thursday the 13th of February. Then all of a sudden, you have a totally different question that you're trying to ask, and that is reporting, but clearly not real time. But you have to have been able to capture the real-time flow of information at the time it occurred and retained it to rebuild that position. And I think certainly a lot of the smaller financial institutions are going to struggle in that space because their systems aren't geared up to work like that.
And the same thing happens, I think, here in that the regulators view very differently an organisation that's got that capability, even if something has gone wrong, from one that hasn't. If they've invested in making sure that they know where they are, what their positions are, and have really seriously looked at it with special purpose systems and so on, then it shows that some due diligence has been taken right there. Whereas if it's all done on spreadsheets, it sends a very different message.
Yeah, I totally agree. I think that, again, in previous lives, having worked with regulators quite closely, my personal view has always been that the regulators balance their view against what they understand that you're doing. And the key is open communication rather than actually trying to treat them like the enemy. And I think, if you can establish a dialogue with the regulators, then you won't have as much of a problem with the regulators if they believe that you're executing due diligence against things. But again, the struggle for any financial institution is always going to be your geographical footprint and how many regulators you have to work with.
And also in regards to the Basel III, I'm not sure that people are intimidated by Basel III as much as there's so much regulation that everyone is trying to digest it and understand how it is going to impact them. But when you look at it, it is there to strengthen the bank's balance sheet and the finances, and to have a better understanding of those positions. So I think it's going to take some time, and more to digest all of the different regulation, because whether it's Basel III, it's Dodd-Frank, it's FDIC, it's a culmination of a global regulatory tightening. And we're going to have to, as banks and as technology firms, be able to translate it, understand it, and then see how it impacts our corporate clients as well as our financial institutions.
Yeah, I think that's a really important point, because actually I think what's happening now is a lot of institutions as an industry, we're struggling to figure out how we take all the different requirements, mash them up into something new, because you can't just take, I guess, the most advanced or the least common denominator and work with that as a benchmark. And again, there is overlap between all the regulators, but there's new touch points as well. So it's how do you encompass all the potential touch points, and I think that's where the challenge really is.
It's not just the different regulations, even if they overlap on them. I mean, I'd be interested in your views, because you're both in banks here, and with your corporate clients as well. The sum total effect of the regulations, if you take the retail deposit insurance, if you take local authority deposit insurance, you take the capital buffers, the EU capital buffers on top of that, you may want to maintain an own internal private capital buffer to dip into. That's an awful lot it's adding up to. And then where are you going to place this? There's an increasing shortage of places to place the money or collateral. There's a shortage of collateral. So I think the net total effect that the regulators are having isn't necessarily being looked at globally. I don't know if this is something you're facing.
No, we've definitely, there definitely is, depending on where you sit on the globe, how this is going to impact your business.